First and foremost, really, I'm just going to talk to you about what's happening in the car market now, what's got us here, and possibly the future for some of these car companies. First and foremost, used car prices may be easing, research shows. This was back in 2022, February. And there was a few things that kind of played into this. You had the chip shortage. There was an insane chip shortage back in 2021, I want to say. It lasted a while. It lasted like 2 or 3 years. But like I said, a lot of these problems started to really ease in, and we started to feel them in 2021 and 2022. So supply chains also played a factor into this. So you can see here, I got this article. It says used car prices have jumped at least 50% over the course of the pandemic. This was February 3rd, 2022. As of January 30th, those amounts showed signs of softening. So you can see here that prices did slowly start to go down. But for cars that are 1 to 3 years old, the average cost was $41,121. Hold on, let me put my phone outside. Used car prices, they have gone up insanely by an insane amount from before the pandemic to now. Like I said, the cars that are 1 to 3 years old back in 2022, the average cost was $41,121. But that price is slightly down 2.1% from about $42,000 early January. So month over month, the prices were slowly starting to drop. Also here we have chip shortage. Apparently it was supposed to cost the auto industry $210 billion in revenue. But the way that the auto industry kind of offset this is they raised prices, right? That's a really easy way to kind of absorb different challenges you may go through, whether it comes to, consumer demand is down or parts cost you more to manufacture and make, just pass it off to the consumer. So prices of these vehicles started to go up. You can even see here in this chart, look here, average transaction price for new cars in the US. In December of 2022, the average price for a new car in the US was $50,000. To me, that didn't seem very sustainable. That did not seem very sustainable. You even see here in this article title, auto prices are cooling, but we're never going back to the old normal. And I can kind of sum this up to you. It's very easy to understand when you think about inflation, because never in a period of time say if you take 5-year trends, yes, you may look at 1 year, inflation was up and maybe prices started to fall down a little bit. But if you look on long-term trends, you will see prices never go down, up and to the right. And that's because money is continually being printed, put into the system. So that's why you can see here, we're never going back to the old normal, because there's just more money now, more inflation, can't go back to those old prices. Underlying components built into new cars, such as technology, as well as high labor costs, and are keeping prices high. A fender bender is no longer a small thing. This is another thing to think about too. A lot of these cars, talking 2020, even 2019, 2020, depends what brand of car. Because, obviously you have like your Hondas, your Toyotas, I'm trying to think of another cheap car brand, Kias. Those cars don't have as much electrical complexity as, say, a Mercedes-Benz or an Audi. Seen as more luxury, right? So they have more sensors, they have cameras around the cars, so many things that could go wrong. So instead of a fender bender just costing you maybe $300 for the plastic or the bumper or whatever it might be, you're now paying $2,000 or $3,000 because you have all these anti-collision and electronics. So car prices are being driven up by all of these things. Now, where am I going with this, and why is the title Nissan No More? I will tell you exactly where I am going with this. Yes, you can continually pass prices off to consumers. You can pass all these expenses off, but you're going to hit a point. You're going to hit a point where the consumer says, either one, I don't feel like this price is worth it, so demand pulls back, or two, your consumer runs out of money. Honestly, I think we're seeing both of them, because this, I would say Nissan is in my opinion, one of the greatest car manufacturers of all time. But that's maybe because I'm biased because they put out the GTR series. But a very reputable, well-recognized car manufacturer looks like they could be going out of business. So you can see here in this article by SlashGear, Japanese car maker Nissan could cease to exist in as little as a year. This was written November 27th, so not too long ago. Japanese car maker Nissan could exist in as little as a year. In a report which first surfaced in the Financial Times, an unnamed senior official suggested that the manufacturer had just 12 to 14 months to survive. They're basing this off of their cash reserves and how much money they can use to stay afloat. How much money they have as a buffer to keep them from going under. So they have declining sales in both the US and Japan and increased competition in China. Now, last week, I had a story and I mentioned BYD and how they're taking so much market share. Look at what's happening. Now you're seeing Nissan getting heavy competition from the likes of BYD and other Chinese EV manufacturers. So you can see why this is a problem. 85% drop in third quarter profits. The automaker attempts to save $3 billion thanks to a large-scale restructure. So what essentially that means is when a company restructures, they're laying people off, they're closing plants, they're trying to trim the fat. They're trying to cut out as many, they would see them as unnecessary expenses, but sometimes they are like to keep growing, right? But they're trying to cut out anything they deem as unnecessary so that they can survive and make it through their tough times. So Renault, because a lot of these car companies, they've been bought up. And I'll touch on that after. There's another one that's looking like they're in some hot water. But Renault, which owned a significant number of shares in Nissan for a number of years, allegedly wants out. So that's their, I guess you could say the main shareholder. They look like they want to get out of the Nissan business. Renault previously sold Nissan shares in December 2023 and March 2024 and announced plans to sell more shares in September. What is a Nissan share looking like right now? Okay, so it's currently at $4.95. What has it done in the last 5 years? Ooh, that's not good. So you can see here in 2020, they took this really hard hit. And it looks like, see, around the time when car prices started to tick up, demand was going up for cars because there wasn't as many vehicles to be bought, essentially because of these chip shortages. They were driving up prices. It was harder to find a car for an affordable, decent price. You can see their stock price started to go up. And then as demand started to cool down, stock price started to take a crazy hit. So yeah, Renault previously sold shares in December. They plan to sell more shares in September. So they're leaving out the back door, making out like a bandit, taking whatever profit they made and just getting out. They do not care anymore. Nissan has numerous manufacturing facilities around the world, which is why so many models are made in the US. So this is going to hurt US jobs as well. And this is why I say 2025 is going to be a really interesting but tough year to watch, because we're going to have to see if all these layoffs continue in manufacturing. Hopefully they slow down, but we really just have to see. Some hope may be on the horizon. And I say this because there's a strong indication that Honda, you know, Civic Gang, VTEC, they may step up and buy Renault's chunk of Nissan, according to insiders. So that's what's happening with Nissan. It's looking scary over there. Hopefully they can pull through, but it's never good when your profits, your sales have dropped 85% in terms of profits. Right? Your profits have dropped 85%. That's never good. So we'll have to see what's going on with Nissan. But switching over to North America, the Stellantis CEO, Carlos Tavares, abruptly quit US Jeep. So this is happening because sales are going down. Sales are falling. So 2 months after a profit warning, which is essentially just saying like, things look bad for this quarter, they're just kind of like a hint, like they're just sprinkling like a hint saying profits might be down. They lost around 40% of their value this year. So their stock price has gone down roughly 40%. It's not looking good for people who hold stocks in like car manufacturers and car companies. The only one I can think of is probably Tesla and BYD. That's it. Everyone else is not looking too good. But yeah, Carlos Tavares, the Stellantis CEO, he just came out and quit. It was kind of unannounced. Tavares' approach came under scrutiny after slumping sales in North America What? Oh, that's a typo. What? That's crazy, Reuters. Reuters, do better. Tavares' approach came under scrutiny after slumping sales in North America led the automaker in September to issue a profit warning on its 2024 results. So that included a forecast for a cash burn of up to 10 billion euros, mostly due to slow sales and bloating inventory. So essentially what's happening is Stellantis they're spending to the tune of $10.6 billion just to kind of keep things running. And this is because of slow sales and bloating inventories. So like I read before, Stellantis shares have lost roughly 40% of their value, while shares of the US rival Ford Motor are down 7%. And look at General Motors. General Motors is up 55%. So at least General Motors, they got some gain on it. So remember back when I said there's two reasons why people stop buying cars. Either they don't like the price or they just ran out of money. What it looks like with this was essentially they've been struggling to sell cars because their prices are too high. Their prices are just too high. People don't want to pay the price. Look, they have 112 days of supply on 112 days of supply on dealer lots of Ram 1500 pickups and Jeep Wagoneers, and that's 20 days higher than their respective rivals. And this is essentially because their prices are too high. Consumers don't want to pay these prices for these brand new cars. But there is the other side of the coin, which is a lot of consumers have just ran out of money. A lot of consumers have just ran out of money. You can see here, credit card debt in the US hits all-time high of $930 billion. So almost $1 trillion of credit card debt. That is 1/35 because the US here, there's actually a US national debt. There's a clock or a counter. Look, you can see right now the United States is in roughly $36.2 trillion of debt. One thing that was really scary to me that I was reading in this article, the debt surpassed the 870 billion peak during the 2008 financial crisis. So now, you're telling me that US credit card debt has hit a rate that is higher than when people essentially thought, because 2008 was a crazy time. I live in Canada, but I have American family. And when I heard some of them talk about 2008, it genuinely seemed like to them, like that was it. Like America was cooked. That's what it seemed like. America was cooked. Even in Canada, you kind of felt it. Like the economy really slowed down. It didn't grind to a complete halt because America's financial crisis was kind of caused by their real estate bubble. Like that was a big thing that really kicked it off. Over here, our lending situation it's very different than how it is in the States. You go into a dealership, say you want a Toyota Tundra. What is a Toyota Tundra MSRP going for? Toyota Tundra MSRP is okay, so they have here 41,000 with prices ranging up to 64,000. So if you guys ever been to a dealership, you know you're not paying MSRP. You have MSRP, and then you have something called sticker price. MSRP is what Toyota says, okay, this car, we would sell it for 41,000. The car goes to a dealership. You know the dealership wants to make money on top of it. They got to get their money on the back end. The representatives got to make their money on the back end. Everybody got to make some money on the back end off of you, right? So you're not paying 41. You might end up paying, honestly, 50. So $50,000, 11% APR, that's roughly like $6,000 of additional debt. That's just interest. So now after taxes, fees, and everything, you're up to like $60K, and say you have it on like a 5-year term, 6-year term. Those are some hefty payments. It's scary, man. It is genuinely scary. I'm laughing because I'm scared, bro. That's why I'm laughing. I'm not laughing because it's funny. I'm laughing because I'm scared. Like, real talk. Car loan interest rates have hit some of their highest levels in recent memory, and a higher rate generally means a more expensive loan, which is what I was just talking about, which can naturally cause an uptick in delinquencies. So, yeah, that's pretty much what's happening. That's what's happening with these car companies. Car market sales might start to pick up maybe in like 2026 when we kind of get some confirmation if we're going to go through a recession. Technically, a recession is supposed to be 2 quarters. Let me pull the definition. A recession is supposed to be 2 consecutive quarters of negative GDP growth, which Canada and America have already seen. But they have apparently changed the definition of what a recession is, right? So we are technically not in a recession. Like I said, we might see car sales start to pick up in 2026 because think about it, by the end of 2025, rates will be even lower than they are now. And once rates are lower, that means interest rates drop. So the price of getting a car will hopefully be cheaper. This will spur growth. People will go out and buy new cars, used cars, and the market will start to pick back up. I don't know what's going to happen to all the inventory, though. We'll have to see.